All right, welcome back to Investing Wizards. I have the pleasure of having Elliot Turner, who's the CIO of RJA Investments, and he's a active member of FinTwit, also full disclosure investor in Koyfin, which shows his private markets investment prowess. But really happy to have you with us today.
Thank you so much for having me, Rob. Excited to be here. I'm staring at the Koyfin factor screen all day lately, trying to
Uh,
get a sense of what's going on.
Oh man, yeah, and sell-offs like these, that factor swing gets a lot of play as people kind of try to understand what's going on in the market, and then also when they have to talk with their partners or their boss to kind of say, "Hey, all growth is selling off, all momentum is selling off. It's not just us." So that gets a lot of play. So cool. Maybe since we're talking about factors, I'd love to start out by asking you to explain your investment style. How do you think about investing, and how would you characterize your investment style?
Sure, yeah. So, while I led off with factors there, it's not really per se something important to my investment strategy. I just like having a sense of what's going on, kind of stick my finger up to the wind, see where everything's blowing. My investment style is what I'd call, growth at a reasonable price. I'm looking for companies that have growth, that have a valuation that I could like sensibly understand and find to be eminently reasonable. I want companies that are quality, right? I want quality in their business and their relationship with their stakeholders, with a management team that's strong, good capital allocation. And then beyond that, I'm looking for situations that are dynamic. I like change. I like investing around change, whether it be the compositional structure of a company's business or change in a sector or in business relationships with their client, with their customers or clients. I like looking for, optionality in a position, something where I could get a result that's beyond what's in the kind of center of the distribution of my expectations. And, I really like getting a good feel for just the qualitative elements of a business, like what they're, how everyone feels about them in all different kinds of ways. So, do a lot of the scuttlebutt work, talk to customers, suppliers, former employees, and to pull it together in a portfolio, like really what I think about is I want to diversify the number of fundamental risk factors the companies in my book are exposed to. So I want to make sure I have a decent amount of different kinds of businesses. So, I emphasize that point because when someone looks from the outside, they might say like, wow, he's got a bit of tech in there. But for the most part, I don't think of any of these companies as technology. Like I try to focus on what their end markets are, what their end business is, and, what the drivers are on that level. Not necessarily like, is this technology or is this not? Is this momentum or whatever it may be? So that's the long story short.
Cool. So that gets into kind of like a portfolio approach, and so how do you think about a portfolio approach of all these businesses when you're trying to diversify the fundamental factors? Like, are you actually applying a quantitative overlay to see where you have different exposures, or are you just thinking about it more from kind of a business perspective to make sure you're ticking different boxes and putting that combination together?
Yeah, no, much more from a business perspective. And then I guess another element that is really important to me that I probably should have put up top is I'm very long-term oriented. So I'm investing on like a 5-year horizon. I'm looking out to see where the business goes. And so we've had this soft target of like 20% turnover, which means to me, where we have a central tendency to about 20 to 25 positions, I have to come up with no more than 5 ideas in a given year. I don't have to act very frequently. And so in a way, some of our positioning is like an output. Our winners tend to get bigger and our losers tend to get smaller. So I don't necessarily want to kind of like, what do they call it? Trim the flowers to water the weeds.
Hmm.
Don't really want to do something like that, but I definitely want to pay attention and have an idea, at least quantitatively, what I'm exposed to. I don't want it to be a driver, but I call it situational awareness. I really want to be like attuned to the environment, and I really want to like just have my finger to the wind and not be totally naive to everything else around me.
Is it just a long book, or is there a short book component as well?
So we have two strategies that are substantially similar. All the securities are the same. We have the hedge fund and we have the SMAs. And the hedge fund, we do some shorting, not very much. I feel like at its core, shorting is a very different skill set than buying stocks. And, I don't think there's enough appreciation of how it's not just the inverse of like what's a good stock to buy. So you can't just invert that thought process. You really need a unique approach, a unique mindset. And, I've found a couple of situations in my career where a short has been the right thing for me, but I don't put that pressure to at all times have shorts on there. Like I want it to be a kind of situation where based on my process, my analysis, like I fully understand it. And, I think in shorts, it's even more important. Like in longs, I don't really try to get timing right, but I think in shorts, you absolutely have to have a timing element. If you don't have the timing element, I think it's quite problematic. And then as the saying goes, markets go up on an escalator, down on an elevator. You have to be far more nimble. You have to be far more ready to act when your short actually works. I've been speaking to some of the best short sellers I know, really trying to learn and get better at it and hoping that, in the grand scheme of things, I consider myself pretty young. I'm still on, the underside of 40, not quite there yet, getting closer. Maybe the pendulum will flip when I get above 40, but I'm not quite there to say that I think I know what I'm doing on the short side.
Cool. I love that. I love that summary description that shorting is not the opposite, or finding a good short thesis is not the opposite or the flip side of finding a good long thesis. And I think it has to do with what you just mentioned in terms of the distribution, and that the distribution on the downside is just limited by obviously zero, and the distribution on the upside is unlimited. And so that, but that in essence creates a much different game in how you think about risk reward.
Right, absolutely. The market is like, as much as people don't like to say it, the market's built to go up. It's an asset class. It has a return. But just because it's built to go up doesn't mean it always will. There will be long periods of time where it won't, and we got to brace ourselves for like potentially a very long time of sideways. But there's an asymmetry, right? Like exactly as you're saying, like, shorting your losses could totally be open-ended. And we saw that. I guess it's now almost 2 months ago, but GameStop is the clearest example of that I've seen at a larger scale. Maybe Volkswagen in 10 years ago, 12 years ago or something is close.
Every 10 years, that same lesson kind of comes up. So 2029, we should expect the next kind of big squeeze too.
Right. And one of the lessons of that is it's not merely good enough to know and say that this price is absolutely insane. Yeah. And I know it's going to be lower than this at some point. You have to be able to like bridge the gap to get there.
Right. And you can't just double down every time it goes against you.
Right. In fact, every time it goes against you, you're doubling down by doing nothing. That's tough.
Right. It helps to have rich friends who can sort of fund you and provide that liquidity.
Yeah, that's not bad.
That's awesome. And so, it sounds like I love the fact that you're so modest and you sort of know what you don't know. But before we get into kind of like the specific investments, if you had to kind of like talk about or name some things that you've learned over the past almost 10 years, starting RGA, managing your own money, kind of like what would be the key lessons that you would highlight?
Yeah, that's a great question. On the one hand, there's more lessons than I could count, but there are a few that I think that truly stand out. One, like you mentioned, like knowing what you don't know, right? That's really important when you get over your skis into uncharted territory for yourself. I'm not speaking uncharted territory for the world because we're like almost always forging unknown territory. But for yourself, when you get over your skis, it could be very dangerous. So like, there's a flip side to that, which is like I think the second most important lesson is always learn, right? Don't stop learning. Always try to push your boundaries. Like one of the things I love about skiing itself is that you have to both, the most fun you can have while skiing is you want to push yourself to the very edge of your capabilities, but not go beyond that. Mm-hmm. So learning where your boundary is as an investor is incredibly important. And I view it a lot like skiing in that sense. The other is, I think, one of the big lessons I had was in a cyclical stock that I thought was cheap and had qualitative elements. And this was going back to like 2012 through 2015. And, don't confuse cheap and cyclical with something that you're going to, hold on to for a long time. If you get it right, be willing to get out of there. And alongside that, if management team, I have what I call a 2-strike policy. I don't let it go to 3 strikes. But if they say something explicit, like this, absolutely, if they use a word that's like completely binary, either means yes or no about something, and the opposite of that factually happened, they don't deserve the benefit of the doubt, and I just get out of there. I don't want to be in a situation where management has told me a lie. I mean, specifically, I'm thinking about Fiat. Maybe it would have been helpful had I said exactly what it was. But when Fiat, said, no, we didn't stuff the sales channel, we didn't do it, definitely not. And then it turns out that, yes, you did. I'm like, okay, hard charging culture, you had a streak, you wanted to keep going, fine. I'm going to watch you a little closer, though. And then when they say, no, we didn't use a defeat device for emissions tests, and it comes out that you did, I don't care if the setup's good for the stock. I'm going to get out of there because I have no conviction. And then, the last thing I'd say is I think so much of this is about your quest for conviction in your ideas. And so I ask myself, if this thing went down 30% before I made money in it, would I then waver in my belief about the company itself? And if I at all find myself thinking that if it went down before it went up, I just sell it right there that day, because, effectively what you're doing is flipping a coin at that point. And I want to be working where I have an edge, where I have conviction, and I don't want to end up in those situations that could end up taking a whole disproportionate amount of mind share when things actually get interesting to look at what you actually want to act on, with conviction. So those are some of the lessons.
So you mentioned Fiat, which is interesting example. Has there been any other kind of like example where the stock was going against you and you just didn't realize that something has changed, and it took you kind of like a little bit longer to realize like maybe the business is changing outside of the management not being truthful?
Yeah, I mean, similar with IMAX, that was one of the earlier stocks that I really thought I got right. And, on a fundamental level, there was a degree to which management wasn't truthful, but there was also a degree to which, they were investing a lot in the operating line to try to grow the business to other areas, including like home theaters in a joint venture with TCL. And they wanted to invest in like 3D and all kinds of other stuff. And it's like, I think I should have been thinking about how they're doing these investments because there's a fundamental vulnerability in their core business, not because they're doing it out of a position of strength, out of having the opportunity and the, taking the success to try to do more success. It was really, I think it was defensiveness. Another one was Grubhub. Grubhub, I really thought I got right. I really thought, if you go back to the beginning of 2019, that DoorDash and Postmates were on the ropes, and Grubhub was really in prime position to, as the first starter with fast growth, to kind of consolidate its dominance over the delivery industry and moving into turnkey delivery. But I think part of the problem is that as much as management said they went all in on delivery, as far as I break down the situation, I don't really think they did in hindsight, and I think it truly exposed that the business itself, the moat, wasn't nearly as strong as I had hoped. And I use the word hoped because perhaps my analysis wasn't strong enough to say as I thought, right?
Well, yeah. Well, we're talking about this with the benefit of hindsight. At the moment, you have to sort of like, it's obviously never clear. So you have to weigh the risks. And that's awesome that you could do this post-mortem and actually go back and sort of like see where the key assumptions were right. But obviously, like, you have to know the future to know where the assumptions are going to break down. And then if we could leave it maybe on a more positive note, what's been kind of like the best stock, or the stock that you've been most proud of over the past 10 years?
Yeah, I really got to put 3 out there together. And they all have some degree of similarity. And, one is truly special because I don't think I'll ever be able to repeat the extent to which it's actually worked. And that's Roku. When I bought Roku, when I told you about my 30% down first before you ever make money test, I mean, Roku, I was down 30% before I had 1 day of owning the stock in the green. And this was in December of 2018. And, I just really, I called it my Hanukkah gift of 2018 because I didn't expect it to be able to fall in my lap that nicely. And, I obviously had no clue that it would do this well this fast, but I really saw an opportunity for them to be dominant in where they are on CTV. And then the other two being like PayPal and Twitter. PayPal was like the first one where I really felt like I was kind of fighting the market, where I had a truly like dig my heels in variant position and people weren't looking at it the way that I was. And that gave me a lot of confidence to move forward as an investor myself. I think it was a formative experience for me. And Twitter more recently is just kind of one that, you know, I feel like I was able to piece together a narrative that had a lot of truth to it that others didn't want to believe, to understand what they were doing wrong and why they would soon start getting things right. And I think we're like, you know, right on the precipice of people truly believing that. So those three together are very fun experiences.
Got it. That's awesome. This is a great segue to get into you talking about some investment ideas, and I think you're going to talk about Twitter and PayPal. So let me share my screen, and we're going to go to Koyfin here, and we'll turn off our videos. One sec. All right, Elliot. Now that we got Koyfin pulled up, I want to talk to you about some stock ideas, some specific stocks that you've been following and have in your book. What's the first one that you want to tell us about?
Yeah, let's go talk about Twitter. It's controversial. It's timely. It's one I've, I guess, become somewhat branded to in the FinTwit community as well. So might as well start there, right?
Yes. So maybe you could tell us kind of like, so this is a 5-year chart of Twitter. And if we go back, so obviously it had an IPO, has come down, has traded sideways for a number of years, and recently kind of like had this big move out of its base. So like what's been happening here?
Yeah, you know, I think that 5-year chart tells a really important story. You know, they IPO'd with a whole lot of enthusiasm, and that enthusiasm set them up for a, you know, I think a situation where it's going to be really hard to meet the enthusiasm. And you can see like 5 years ago, things were not very good at the company. The stock was at its lows. You know, I think it was getting down to like a $10 billion market cap or EV value in that range. And people were really not necessarily, I think one of the problems for Twitter itself was they didn't know their own essence. They didn't know what they were supposed to be. They came out with this hype. They were being looked at as like a Facebook kind of everything. Every way people defined Twitter was vis-a-vis Facebook, as opposed to like having their own essence. And the company itself was trying so many different things, and they didn't really know what would work. And, you know, we're looking at 5 years ago where things basically, you know, were as bad as they could possibly be for Twitter in a lot of ways. Jack Dorsey had just come back as CEO. And, you know, I think the crucial point for me was I got involved in 2017. And one of the keys for me was, I think Twitter, when Jack came back, kind of focused on its core and redefined their essence. And I obviously started small because I'm not a turnaround investor per se. And I didn't exactly view it as a turnaround situation. The way I saw Twitter was like, if you know, that Warren Buffett line, you want a company that any idiot uncle could run and it's still doing fine.
Yeah.
I probably butchered the exact line, but that's basically what it was, right? Twitter was still doing fine as a product. You know, the business had hit some skids, right? They weren't growing as quickly on the revenue side of things as they should have. But like, they weren't really losing users. Their most engaged users were still as engaged as ever. And, you know, by and large, like, it still had a whole lot of white space and a lot of low-hanging fruit to capture. But, you know, I think what's happened, and explaining more recently, you know, I really felt that there was a different narrative beneath the surface. When Twitter came into existence, it was actually just a gateway. It wasn't really a website. There was no twitter.com. Like, Twitter wasn't founded as that. It was founded on SMS, right? And so, you know, they had everything that you see as Twitter today. Well, not today, but going back to a couple years ago, was something they acquired, someone who is using the Twitter API to build a tool. And all of this stuff was patched together, and Twitter infrastructure was really a mess. So when Jack came back, they focused to the core, kind of rebuilt everything from the ground up. One of the biggest of those tasks was last year, rebuilding the ad stack entirely. And so now that you have a new user backend, a new ad stack backend, they could finally start developing product and innovating. They could finally start, putting themselves in position to kind of create more blue sky opportunity. As far as we had been thinking about Twitter, is pretty static as a service, and that's good and bad. But like now, when you add in spaces, you add in ephemeral stuff with fleets, and you have review and newsletters. I like the phrase that Jack used. It gives them a whole lot more surface area. Surface area both to give people interesting experiences as a user, and surface area for Twitter itself to create monetizable opportunities. And so, I think the market's finally starting to understand it. Last March was when we made it a really big position because, they kind of had already signaled that the new ad stack would be going live by the summer. They were aiming for the Japan Olympics as the launch. Obviously, the Olympics got postponed, but, the fact of the matter was COVID disproportionately hurt Twitter compared to other platforms. But if you fast forwarded a couple of years and believed at some point the world goes back to normal, brand spend resumes, events resume, Olympics happen again one day, and they're in a position to finally start like iterating, innovating, making exciting, interesting things happen, everything's different. And so, there's a growth story again. And I think if you sum up like what I try to look for, it's, you buy GARP and hold growth. And, hopefully we're in that phase of things right now here.
So do you look at technical analysis at all?
I do. Yeah, definitely. Especially for like timing into positions. And what I really try to look for as well is opportunities to add to positions.
Got it. So one thing, kind of like, I'm sorry to chime in here, but I actually hadn't seen this long-term chart. This is one of my favorite technical setups in that you basically have a massive base, a massive sideways pattern, where Twitter was kind of like, this was clearly a resistance level, and you had this huge turnaround, this kind of rounding bottom, and this gap over here on this earnings release where they generated more revenue than they've ever generated, clears this resistance level. This is this is one of the I usually give charts a 1 through 5. 1 is being a sell, 2 is a medium sell, 3 is a hold, 4 is a buy. Something's in trend. This is a 5. There's very few 5s in the market. Like this looks really, really great, and obviously you could see it here on the revenue side. They're breaking out to a new level, and this is the beginning of a growth phase. So this looks terrific. You mentioned kind of like some of the new initiatives that they're doing in terms of spaces and fleets and stuff like that. Are you excited about one particular area where they're going in terms of how they're trying to monetize?
Well, it's not necessarily directly how they're trying to monetize, but philosophically, I love that they've embraced this idea of creative empowerment and giving opportunities for people who, it's user-generated content on Twitter, giving opportunities for Twitter itself to power the experience and to power monetization for their users. Mm-hmm. And I think that gives Twitter the right to ask for more money for different things. So I think, some people are maybe slightly disappointed that they've said that tipping or, take rate on newsletters or super follows won't necessarily be a big business in its own right. But if you kind of peel back the onion and listen to exactly what they're saying they have opportunities to build tools to power these people who are going to make money in that way, like a better tweet deck experience that people would pay for. One of the things that I'm really eager to see perhaps is something where with your profile, which is great real estate that's had very little happening, give opportunities to pay to featureize the profile. And then in terms of actually paying, getting creators paid, I think, something like Robux as an example for how they could approach it, where, Jack, who's a Bitcoin enthusiast, and Kayvon had mentioned creating a Twitter coin, create a Twitter coin, like make each coin backed by $1, infinitely divisible, give people the opportunity to kind of buy 100 of them at a time. And then, that solves the small transaction problem, right? If I wanted to tip you, Rob, $1, that's really hard because, the payment system itself and the tax from Apple means that, you're going to have less than 50 cents of the dollar actually going to creative. But if you create these bucks, create an ecosystem and give opportunities for people, you could even like have Twitter itself use their balance sheet to kind of grease the wheels of excitement for creatives, like say kick in, $10 million to the pool of it, that everyone who's got a Twitter account gets $10 that they can hand out to people that they'll be willing to cash out, and just kind of create this motion and create a process. I think that would get really interesting. Now, obviously, I'm speculating a little on exactly what their intents are, though there are templates that we could look at to see exactly how it's done elsewhere. And they have dropped some hints. So I really do believe that might be one of the ways. And just in general, I've always wanted, Roku's been one of our longstanding positions, and it's been, way better than I ever could have imagined. But one of the things I really learned from Roku is the power as an advertising company to have credit card credentials for an account. And so Twitter obviously has a lot of anonymous accounts on the platform. And, one of the critiques that the ad community has is they don't know as much about their users as Facebook does. But once you have this wedge where you have an opportunity to ask people to put their payment credentials in, you can learn a lot about people. And you could do it in a tasteful way, in a data compliant way, whether you're talking about GDPR or CCPA, whatever. You could do it in a really good way. And then you could buy, second and third party data sets to get an even better picture of who their customers are. And then suddenly, you're not just talking about creating opportunities to ask people to pay directly for product, but you're also going to get opportunities to better target marketing to people, right? So, all around, I think it's a virtuous cycle that is just kicking off now. And we're only at the tip of what they can do. And then, what I really like, what's important for me is, as much as I'm talking about what can be, when you focus on what is, if they just get back to 2018's level of ARPU with their existing product today, this thing's pretty damn cheap. So, I'm not paying for this stuff I'm talking about that's more like aspirational. I'm paying for something that's very achievable. And if they do get this stuff right on top of it, it's going to be really damn good.
Got it. Just in terms of, if we just think of it in terms of, do you look at it on EV to sales or EV to EBITDA, or you think kind of like valuation right now is a little bit understated because the numbers, the actual fundamentals could go up by a meaningful amount over the next year?
Yeah, this one's hard to look at on either because of how disproportionately hurt they were with the COVID brand spend shutdown. But yeah, of course, I definitely look at EV to sales, EV to EBITDA. I think forward, I've kind of been, since the COVID period when I knew things would get worse, I've been focusing on what I think 2022 EBITDA should look like, thinking that that's the first year that we truly get back to at least some semblance of normal. And, I think now, especially with their analyst day, where they kind of reaffirm their long-term margin targets, and they put out the $7.5 billion revenue target, which, I think they think of more as achievable than aspirational too. That effectively triangulates to like a $3 billion EBITDA opportunity for 2023. And, I'm sitting a little bit above that, but I think in the grand scheme of things, compared to these other platforms, with the growth rate they should be exiting 2023 with, right? They're just accelerating things. I think that's eminently reasonable. Right now with today's EV, you're talking about something 15 times or less, that 2023 $3 billion number.
Got it. Interesting. And so consensus right now has EBITDA growing at sort of 25% high, kind of high mid-20s digits, which is
yeah. So it's kind of funny, like, when they put out that framework, I'd already been sitting near those numbers, right at them basically in a lot of ways. I was lighter on MDAO and I was higher on ARPU, and the street was just way behind. Just didn't want to believe there was an opportunity at all for them. The street was lower on MDAO, though I was more in line with the MDAO side of things, but on the actual ARPU opportunity, like Wall Street in their terminal state is implying that Twitter would never get back to 2018 or 19 levels of ARPU. It's like, that's just not going to happen, And so even though Twitter's put out this framework, just about every analyst other than Heath Terry, who's no longer at Goldman Sachs, was sticking with numbers that were below Twitter's framework. So, that's why I think they're very much still a show me company. No one wants to believe that story about Twitter having been a mess and cleaned it up. No one wants to believe that they could actually execute now. I fully believe it. And so, I think that's where a lot of alpha will come from here.
Got it. Let's see if I haven't checked short interest on Twitter in a long time. But okay, so that's That doesn't tell you much today.
Yeah, I think quickly, just from people I know, things I've heard, like after the Trump ban, there were a lot of people who piled in short. And, I think it pretty quickly, before it even got to show up in short interest, was a painful place to be heading into their earnings. So
Yeah.
I don't know. Maybe that's that little spike that we're seeing on the very right side there.
Yeah. Got it. So nothing meaningful here, but yeah, pretty controversial name. I know like people who are on Twitter, as you are, as I am, are super passionate about the product and the value and the potential. And I think a lot of people look at Twitter and they'll say like, oh, like Snap or Pinterest and other companies are have a different profile, have a different demographic, have been able to execute over the past several years in a more clear fashion. But I think everyone who uses Twitter sees that potential because they're so engaged with the product.
100%. I think that's a big part of why like some of the most engaged and passionate users actually like refuse to embrace the stock because they're so frustrated by what they have or have not seen in the user experience
Right.
to date. So I think that definitely like weighs on sentiment a bit, but I think there's just this big warming that's happening. And I think suddenly, you could end up in a situation where it's cult-like, where the people who use it most, you know, are most keen to own it. And, I think it's been helpful being involved in the platform to like see and feel the actual inflection with the product rollout cadence and the new features. And, that makes a big difference. So I think, you and I are in position to experience the change and the inflection in culture at Twitter faster than someone who's just watching from afar and thinking about the company.
All right. Cool. Awesome. Love that pitch. Love that story. Let's go to the next one.
Sure. You want to do Naked Wines?
Yeah, let's do Naked Wines. I know nothing about this company, so it looks like it's a British company.
Yep.
Okay.
So this is one of those setups I love where it's a British company, but the real opportunity is in the US. So there's like a fundamental mismatch between their investor base and, where the actual growth is going to come from.
Mm-hmm.
And then, I think this 10-year chart is awesome because like it tells a story that, if you understand the backdrop, you'd realize that the company that you see to the right side of 2020 is not the company that was to the left side of 2020. Mm-hmm. Naked Wines was not called Naked Wines until the very end of 2019. It was Majestic Wines. And Majestic Wines was like, if you guys are familiar with Total Wines in the US, I know I have one near me in Norwalk. It's pretty big in the South, I think, too. Majestic Wines was is still a high quality brick and mortar wine and beverage store. Mm-hmm. And, it was very much like a tapped out growth opportunity. So they were one of those high free cash flow, high dividend yield companies. And in 2015, they purchased Naked Wines, and you could see where they had, a strong spurt on the chart with some volume in 2015. That was like, oh, wow, these guys just bought a growth asset. This is awesome. A growth e-com asset, no less. Mm-hmm. And Rowan Gormley, the founder of Naked Wines, ended up becoming the CEO of Majestic to try to like really tap into the growth opportunity. But because their investor base was so used to getting these really lush dividends, they were really restrained in what they could do with Naked Wines. So in the middle of 2019, they're like, hey, why don't we sell ourselves being Majestic, and go all in on this Naked Wines opportunity, right? So, the company today is not that company. They cut the dividend to zero. Mm-hmm. So they went from, paying a pretty nice yield to paying none. Mm-hmm. And they, on a go-forward basis, were like, we're going to invest 100% of our profitability in growth. And we're going to do that because we have really good unit economics and we have a provable, repeatable process for acquiring customers in a very disciplined way who have very similar traits to our existing customers. They brought in this gentleman, Nick Devlin, to be CEO, really sharp, really nice guy, got a great vision for what Naked Wines can and should be, and a really strong team behind him. Like a lot of the original employees of Naked Wines are still there today. And, when I said that the US is the growth opportunity, this product started in the UK. And effectively, it's subscription-like, but not subscription. So you pay, in the US, what we do is $40 a month into an account there called your Angel account. And when you pay $40 a month into that account, it builds up, and you could choose how to spend it whenever you want to buy a case of wine. And when you buy a case of wine, you could choose all the different kinds of varietals that you like, and their price in the US, the price to value proposition is extremely attractive. So because the US, when you buy a wine bottle at a liquor store, it has to pay the vineyard a margin, it has to pay the distributor a margin, and the retailer a margin. It's the three-tier distribution system. But Naked Wines is the vineyard of record. They have a vineyard out in Napa, and they, contract the winemakers and to make these really high quality wines. They help them with the process, help purchase the grapes, help with the crushing and bottling, with providing facilities, and they sell and distribute themselves. So they could sell kind of on Vivino when you look at like 4-star wines. Naked Wines equivalents, Naked Wines 4-star wines sell for like 30 to 40% less than others from the industry. And the beauty of that $40 subscription trait is that it's twofold. One is you get very good visibility into future demand, because if you're putting in the $40 now, in the future it's likely to be spent, right? You're not putting in $40 to not spend it. And the other is that the money comes in before it's actually turned into revenue and sold as product. Therefore, that actually finances inventory, right? So they don't have to invest in inventory. Their customers are investing in inventory on their behalf. And that gives Naked the opportunity to like promise good demand and visibility to winemakers, and makes it incredibly attractive for winemakers. So it's like a huge win-win for the entire ecosystem. And the company's trading, I think, what they're going to do in sales, like their market cap today, is not much more than like 1.5 times sales. When we started buying it, it was like 0.7, 0.8 times what we thought they'd do in 2021 sales. And they're investing mightily in growth. I think they're they should be, their guide is for something upwards like just shy of 60% year over year growth. I think they're probably going to come in more in the 70 to 80% range. I think their guide is really damn conservative. And so obviously one of the questions is, are they a COVID winner who's, largely ephemeral, whose benefits are largely ephemeral? Or are they a COVID winner who now has a better platform to move forward? And I think they definitely are one of those winners who has a platform to move forward with. They used some of the excess COVID earnings they had to kind of help and invest in the winemaker community. So they did a COVID relief fund, spent $5 million buying bottles from really high quality winemakers, one of whom I really like, this guy, Jesse Katz. He was like 30 under 30 in the industry, and he's going to be making wines with and for Naked down the line. He makes Justin Timberlake's like private label bottles, and really, really high quality wines. It's like different than what the entire company's been associated with. And I think the real opportunity is effectively going from what's called, what I describe as cheap quality to affordable luxury. And I think affordable luxury, as the essence of the company, opens up a whole lot of doors. And I think that's where they're going. So when you think about their unit economics, what they've done, the industry itself, the wine industry, was geared to sell $60 to $80 bottles of wine. Instead, Naked Wines built their muscle of selling profitably $12 bottles of wine. And when you compare, like with a $60 bottle of wine, if you're going to ship 12 of them and it costs $60 to ship the whole thing, that's fine. That's like, a 10% markup, no big deal. But if you're going to sell $12 bottles and you mark it up $60 with shipping, you're talking about over 50% premium on what you're actually buying in grape, right? And so they learned how to ship that stuff for $20 for a bottle of 12, basically. And I think that gives them a huge advantage, especially as they're able to like add more quality, and they could modestly drive higher in price. So go from 12 to like, $18 to $20, maybe not much more than that per se. But if they do that, they'll get 2 to 2.5 times the contribution profit per case. And so, I think there's a really, really big runway. I think there's a big opportunity to modestly premiumize the product. And I think there's great leadership to pull it off. All the while, it's just very cheap. I think you're paying like a mid-single digit multiple of what they define as their steady state EBIT. So mid-single digits of EBIT if they were to choose to operate in standstill. And they are very transparent in what they mean by steady state. They tell you exactly what portion of their marketing goes to growth versus maintenance. And that maintenance marketing is what is a cost against steady state, but growth is not. And so, I think their disclosures really help you get a good understanding of how good they are as a company.
So are they what they have physical stores? Is that correct?
No. They have a
They do?
physical vineyard in Napa, but
Okay,
no physical stores. It's all e-com, all by mail. So DTC, direct.
got it. And how are they acquiring customers?
So yeah, that's a really good question. Historically, when they had this narrow mandate under Majestic, they acquired customers by inserting flyers, and I bet you've seen them and thrown them out with like Wayfair, Bed
Mm,
Bath, and all
yeah,
kinds of other like e-com shipments. You know those
yep,
little flyers that no one ever looks at. Yet
absolutely.
people do, and they actually get great ROI on it. That's how they built their entire business. But only in the last couple years have they started investing in digital marketing. So obviously, Facebook. They actually have some good results on Twitter, surprisingly and happily for me. And they have good. They're experimenting and expanding. I think they're going to start doing some brand advertising. They've never done that in their history. I think driving some unaided awareness would really be helpful, so that people, when they see Naked Wines, know it's like not just that they know it's a very real and quality entity. So I think that's part of what I think the better resources they'll have coming out of this COVID period will enable.
Interesting. And is there like like this company is pretty small, which is really nice because obviously it means they have a lot of runway ahead of them. Is there kind of like a bigger company to look to, or is there kind of a revenue opportunity to look to for this company if they're able to execute and really grow over the next 5 to 10 years?
Yeah, I mean the way they think about it is that the sub call it $40. I might be slightly wrong on the numbers, but it's like the sub $40 per bottle wine TAM is $20 billion. So it's a massive TAM and it's way underpenetrated. And alcohol as a vertical, like, is way underpenetrated in e-com, and people don't really realize the extent to which, you actually can. The biggest hurdle is people don't know that you could buy alcohol online, and you very much can. And if you look, like Uber just bought Drizzly, which is like
Hmm.
call it the Grubhub of alcohol for $1 billion. Naked Wines, has more sales, isn't even there, has better unit economics. I mean, it's really hard to find perfect comparable, but like, when I think about it and when I look at it, I think, at the very least they should have the same price to sales multiple as the likes of Stitch Fix and Wayfair. At the very least, probably it's got some degree to which it's a better business than either of those, because it's, subscription like, more predictable in end demand, and they inevitably should have a higher margin structure than either of those. So like, I haven't wanted to get over my skis saying like, it should be something truly phenomenal, but yeah, it's a massive TAM that's way underpenetrated. So the sky's kind of the limit in a lot of ways.
That's awesome. And then going back to my little technical analysis voodoo, 10-year chart, huge base moving sideways, nothing, 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 and then moving out of that base on pretty substantial volume. Like something's happening here, and I love that this chart is confirming or echoing some of the thesis that you've laid out.
Yeah, right. It's pretty amazing there. I like that visual. How long it did absolutely nothing, and it's going now.
Yeah, the market's telling you something's changed here. That's awesome. Cool. Let's move on. What's the next company you want to talk to us about?
Let's look at Kambi, because it's got a similar backdrop to Naked Wines, insofar as it is a European listed company whose best growth opportunity is in the U.S. Right?
Hmm.
Same story, different industry, and I think it's an interesting story. So Kambi is like a B2B provider for the sports betting industry. They, as of today, still do the back end for DraftKings. So at some point, DraftKings says by the end of this year, they won't. That's a known thing in the market. But they also do the back end for Penn Gaming and their Barstool sports betting app, which is going national these days. And by going national, I mean, that's a big part of the story, right? In 2018, Supreme Court repealed PASPA, and you were able to start having sports betting legalized on a state by state basis.
Hmm.
And in some ways, COVID's been an accelerant of that, because budget conscious states like my state of Connecticut, who you kind of let it slip through the cracks, now have a sense of urgency and they're going live with sports
Hmm.
betting. And sports betting is a pretty big TAM. It's not quite as big a TAM as wine, though. It's also like, we won't know exactly how big it is. When I started with the industry, Morgan Stanley was saying like 5 billion. TAM in the US. Then they're at 7.5 billion. Now they're at 10 billion. And it's really hard to say. The real question is, do Americans bet like Brits who bet like $30 ahead a year, or do we bet like Aussies who bet $45 a year ahead?
Mm-hmm.
Truth is, we're probably somewhere in between the two. But needless to say, it's a really big market opportunity. It's one that's coming online really fast. There's a brick and mortar to digital phenomenon here that I think is undercovered by people who look at the industry, because when you were constrained to brick and mortar for sports betting, effectively what you had was you could bet on, the line, an over under, an outright in a game, and you could bet futures. Like I always in Vegas would bet on my Islanders to win the Stanley Cup, because why the hell not, right? Those were the kind of bets you could make. But then when you look at online, my God, there's so much more surface area to explore, right? You could have betting on just about any situation within a game. And you could do it from your couch without having to go to a place. And, obviously you have to balance some risks of not wanting to make people prone to be junkies with this. So, there's a degree to which you have to know your customer and, as an industry, be responsible and promote responsible betting. But overall, the opportunity is really big to make it more interesting, more engaging. And Kambi gets to make pretty good money along the way. Their margins are already very nice, and their incremental margins are otherworldly. And it's very much a fixed cost kind of business. So as they grow, they really don't need to add much incremental expense. Effectively, what you have is a trading floor. And so what Kambi does, there's three ways to make lines in sports betting.
Mm-hmm.
First, what you could do is you have your own proprietary model and you put out a line. Second, what you could do is you could look at all the other people who have lines and you could scrape them and say that that's your line. And third, you could kind of like set a preliminary line as a market maker and see where the flow, supply and demand drives the line, right? The best could do all three. And then what Kambi really does is not only do they do all three, so they're really sharp at each of those elements and they have true integrity over the lines, unlike some other providers in the industry, but they're also able to do really good customer profiling and risk management on behalf of their partners. So the way their business model operates is they take like a low double-digit take rate of the revenue they're able to generate for their front-end partners. And the skill of a front end should be acquiring customers and making a good experience. They don't necessarily need to put the resource toward the back end side of things. So yeah, you can see Kambi's had pretty phenomenal growth. And a lot of that growth, what you're showing on the bottom here is the EBITDA margin. You can see how much the EBITDA margin jumped from, even think more of 2019 as a full year, from 2019 to the end of 2020. And, I think it'll continue to be the case. And, one thing that I like about Kambi is effectively when we got involved, we were buying the European business, which was like a 10x EBITDA multiple. And we were getting the US business for free, basically. It was pure upside, pure optionality. And even though that's been priced in, I think, assuming the big question is what's the end state of the sports betting industry going to look like? Is it going to have like dozens of front end providers, or are we going to consolidate down to like, a handful and, 80% of the market share is dominated by a handful of players and 20% the scraps are by, call it the local champions between, some regional casino operators and some of the native tribes who have licenses in different states. And for me, the way I break it down is so long as Kambi is able to get somewhere between 15 and 20% of the industry in the US on their platform, this thing's got good upside. And then, I haven't even really broken down the Latin American opportunity. Some people in Europe think it's a bigger opportunity for Kambi than the US is because they won't be competing with any integrated players and their markets are going to be even more concentrated. So that's like pure optionality on top of what I think about today. It's one of the most interesting companies that I've seen, and perhaps they should be listed in the US because, again, most of their growth opportunities here are not necessarily in Europe these days. Europe's a very, very mature betting market in contrast.
So when I think of like Kambi and the service it provides, which is kind of the back end infrastructure layer to these betting companies, is a company like DraftKings, are they going with a competitor of Kambi or are they creating their own
Yeah, that's a great question. So Kambi had basically one competitor who was doing B2B, and DraftKings bought them. And
Got it.
DraftKings paid a price that was like, at the time it was more than Kambi's own market cap. And that competitor is really, I think, just not a good product. It's a pretty bad product, and the biggest proof that it's a bad product is the competitor's name is SB Tech. SB Tech had won the Oregon Lotto business. So, every state has a different approach to how they're going to regulate the market. And some states like Oregon, Delaware, and New Hampshire, the state itself, their Lotto commission operates sports betting. So SB Tech had a monopoly as the provider in Oregon, and they're still losing money. They don't even have to acquire customers. So DraftKings is losing money because they're acquiring customers to a greater degree than they are like harvesting the margin from their existing customers. Their contribution margin positive, in other words, they're just spending to drive growth. Oregon doesn't have to spend to drive growth at all because they're literally like a state sanctioned monopoly, and they can't make money because their back end just is not good enough. And, another thing that happened pretty quickly after DraftKings bought SB Tech, Churchill Downs, their Bet America product, was doing pretty poorly in the market. They had been built on SB Tech, and they have aspirations to be, a formidable player here. And they switched from SB Tech to Kambi. So the way I see it now, their foremost competitor is Scientific Games, and they have a pretty good offering. They bought several really good assets and kind of tied them together. They did not have a good go-to-market motion with those assets. They were like very separated. These companies, Don's Best, that provides lines, and NYX, which owned OpenBet, which was the big legacy provider, like basically covered all of Las Vegas. And, I think effectively the way it boils down is SciGames' pitch to potential customers is, hey, you're a casino. We'll give you your, slots, and we could do some iGaming, and, we'll throw in sports betting, right? With a good enough product. So it's one thing, right? For a lot of casinos, a sports book is a lost leader to get people in to lose money or spend money in other ways. Whereas Kambi competes on, if you want the best sports book, you have to work with us. And so, obviously there's some casinos that want to have the best, and there's some casinos that are okay, just checking the box. But, I like the industry position in that sense. And I guess the other competitor is the unmentioned competitor of like a truly integrated product. So, GVC in their joint venture with MGM, BetMGM, is what I'd call an integrated product, and it's a pretty good one. Everyone else, though, including FanDuel, leverages some degree of outside vendors. So FanDuel had switched about this time last year. They announced that they were switching some of their back-end services. Though they do some of their own, it's more a hybrid model. Kambi's take it or leave it. But FanDuel uses, they switch from IGT to SciGames. And IGT's product is just like, I'd call it non-viable. I don't even think of them as a competitor at this point.
And is there kind of like a scale intelligence issue? Like the more providers that you service, the more betting books that you service, the more intelligence you have?
100%, especially when you think about that like market maker like function where the more flow you see, the more you get knowledge into how lines should be placed.
Right.
And it's especially true when you could segment your customer base into the, understanding of this person's a sharp bettor versus this person's a punter, right? And, you really want to move your line consistent with where the sharps are betting more so than where the punters are betting. And Kambi's able to do that, and they have true integrity over that. And so, yeah, it's definitely a scale thing. The more scale you have, the more wisdom you have when you're making lines. And the better you could be, the more resource you could give toward this. So, to truly be able to try to in-house the product, you have to have immense scale. And there's a really balkanized regulatory regime in the sports betting space where every state has a different approach. And because of the Wire Act on a federal level, you actually have to have a server on the ground in each state you service. So it's not that easy to get started, and it's not easy to acquire scale. And there are frictions to truly, like, let's say you have like, an Eagles Patriots game and you have a lot of flow coming on the Eagles in Philadelphia. You can't really match your book by moving money, to the New England side of things. But, when you're a scale player in aggregate, you could kind of like have your profit pools fall in line based on these flows and price your lines a little more appropriately.
Hmm. And so if like before I pulled up this chart, if you were to tell me that this company does online gambling, sports betting, and just knowing what the charts look like of DraftKings and Penn and stuff like that, I would have guessed that the multiple has been going up over the past 2 years. But here the multiple is sort of like right in line with the past 5 years or whatever it is. Why is the market paying more for these earnings and for this higher growth rate and opportunity?
Yeah, right. I mean, it's a combination of things because you could see the chart of the stock is definitely going up and to the right, but the multiple is compressed.
Yeah.
So there's definitely some of that going on. And yeah, I think part of it is like no one wants to truly price in persistence of DraftKings earnings. So DraftKings is their second or third biggest customer, depending on how you break it down. And no one knows exactly how much share Barstool and Penn will get to offset the loss of DraftKings. But I think it's more about thinking in end state terms than it is about focusing on client churn or additions today. And I think it's just a matter of time. I think part of it is like Swedish investors don't grasp the growth opportunity in the U.S. as much as U.S. investors. Though I've met some awesome Swedes who truly do understand it and have been buying into that opportunity for a long time. But yeah, I think that's when you think about it, like U.S. investors also don't have an opportunity to buy Kambi that easily. They don't have an ADR here, so I also don't think Dave Portnoy's ever said anything about Kambi itself, which to me is kind of an optimistic thing, right? This is his back end on the Barstool app, and he hasn't even given them a shout out because I do think down the line. There's a poison pill that Kambi came into existence, spun out of this company, Kindred Gaming, and Kindred's listed in Sweden as well. But I think, Kindred has a poison pill that expires in 2023, and it's possible that someone like Penn looks to kind of buy and put them in-house or at least use it to kind of fulfill broader ambitions.
Cool. Yeah, the Swedes definitely, they know, what do they know about? They know about furniture, they know about streaming music, but not much about.
Some great companies that come out of there too. Like one that I looked at that I passed on that I should have taken was like MIPS, the ski helmet technology. But yeah, there's some awesome companies. I like hunting the Scandinavian markets. They're really interesting, good like equity ownership culture. Executives are paid far more reasonably than in the US.
Yeah.
And they kind of like, get priced at much lower multiples than equivalent US growth companies. So it's a pretty fertile pond to fish in.
That's pretty cool. And Elliot, when you buy these companies, when they trade on other exchanges, how do you do it? Do you use like a broker that we all have access to, or do you have like special relationships with more institutional brokers?
Yeah, well, we use TD Institutional for the SMA side of things, and our hedge fund is in Interactive Brokers. And on IB, it's like piece of cake. On TD, the institutional side, it's pretty easy. It's a little harder on the retail side. You basically have to call them and tell them other people who've done it and explain to them how to do it. And it's quite frustrating, but it's a good way to, end up in these situations where there's a huge mismatch between the true value and how the market's pricing them.
And are you hedging currency at all, or are you just buying the local shares?
I prefer not to hedge currency, especially in companies who are profitable, because, if FX weakens in their cost structures in Europe, FX weakening being like if the euro goes down in price, they're going to make up a lot of margin, right?
Mm-hmm.
So, I think it was in Credit Suisse does this annual yearbook of charts, and they had episode, might have been as much as 8 years ago, focusing on should you or should you not hedge FX? And they're like, if your time frame's longer than a year, it's always going to normalize because what might be a revenue boost one year is a margin boost the next year. So yeah, I try not to get too cute because I have no special skill or know-how in FX. I just want to own the businesses.
Got it. That's smart. That's smart. Just to kind of like say, hey, it's just gonna wash itself out in the long term and not spend mental energy thinking about it.
Exactly right. That mental energy is huge, right? The less decisions we make, I think, the better off we are at the end of the day.
Absolutely. Cool. That's awesome. What a great conversation. Really enjoyed learning about all these names and your investment style. To close it out, would love to, I guess these lockdowns are hopefully ending pretty soon. Looks like things are getting better. Is there kind of a movie or show that you could recommend to everyone that you've been watching or that you've watched over the past several months?
Oh yeah, I've been loving *Halt and Catch Fire* lately. I can't believe I never heard of this show sooner, but it's really freaking cool. It's are you familiar with the show at all?
Remind me, I've heard the name. Remind me again what it is.
Yeah, it's basically like '80s emergent computer technology startup story, and it's got so many great plot lines about family, about the role of women in the workplace, about technology and what it means for our lives. Starts with more hardware, gets into gaming and software, and it's just like really well written, well acted out. Truly great drama. I think it's one of my favorite shows I've stumbled on in the last year plus.
Got it. Cool. We'll definitely check it out. Awesome. Thanks again for your time. And you can. What's your Twitter handle on what's your handle on Twitter?
It's at Elliot Turn, ELLIOTTURN.
Great, and we'll put it in the show notes as well. Thanks so much, Elliot. Really appreciate it.
Awesome. Thank you for having me, Rob.